It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, as always, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, Mike, we've been anticipating a near-term pullback in the markets. It's a feature of the markets, and still the exact timing and magnitude of it is always unknown, and it's emotionally challenging to go through. So what's causing the recent pullback when markets bottom, and what adjustments should you make to your investments? That and more on the Wise Money Show today.
That's right. We're focusing on the markets. Obviously, it's been a tumultuous year thus far. And should you make changes? Should you panic? What's driving all this? Are we near the bottom? We're hitting that right now. If you have a question for the program, we'd love to hear from you. If you have needs or questions or whatever, we can serve you. Reach out. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. All right. Yeah, it's been just a wild start. This is currently the second worst start to a year ever. Now, that data point was sort of alarming back in like February. Yeah. It's almost June, and we're talking about start to the year. No, we are through this year, and still it's second worst, second only to Great Depression. Now, there was all this talk about FOMO. This is the opposite of FOMO. Okay. So fear of missing out.
Yes, good. Thank you. For those 40 plus, you need to know.
I had to look that one up.
So I don't know. I don't know what the opposite of FOMO is. It might just be F, and that is fear. And so what is driving the markets? Will we see bottom soon? Guys, let's get into it.
What's driving the markets? I think, to me, we've got to go back to what was the condition in the markets before we even came into this worst start ever? And you got to look at what was the conversation we were all having with our clients back in the fall of last year, 2021. And it was concern, it was warning, because when you looked at the stock market, it was we were using the word bubble mostly because when you look at how expensive the stock market was coming out of last year, the most recent thing that you could compare that to was the dot-com bubble.
Yep.
People paying such high prices to own stocks that, were profitable, but boy, were they that profitable? Did it make sense to be that high? And, we were warning folks back in the fall that, boy, for the stock market to come back down to a more normal or average level, or the expensiveness of the stock market to cool off a little bit, things would have to fall pretty sharply, or investments, the companies themselves would have to get fabulously profitable.
Yeah.
And here we are, just, the most recent news that we've been seeing in the market here has been, maybe some of these companies, retail companies in particular, maybe they're not quite as popular or as profitable as we thought they would be.
Well, so I'm glad that you talk about the warnings that were being shared back in the fall, because as Kevin mentioned, we've been anticipating this. However, you can't perfectly time it. It's just, I don't know. If we could, I would have expected it to happen last fall, which there were some jitters. You can't perfectly time it, and you can't perfectly know the magnitude. But yes, the forward price to earnings ratio, as Josh was talking about, prices were elevated compared to earnings. But then the other warning was, listen, earnings are record highs. Right. The profit margin has never been better, and the price compared to those profit margins was astoundingly high. Yeah. And then we were feeling and seeing inflation, and so the reality or the likelihood that those profit margins could be maintained was very unlikely. And so all of that sort of got pushed together, and be careful. I remember telling clients, based on I don't know, 50 years of data, 5 years from now, we shouldn't be too surprised if the stock market's still at the same point today. And how we're going to get into, hopefully, the 10 rules for investors. And one of those is markets don't correct sideways. meaning when valuations get stretched, it's not like the markets just go flat and wait for the economy to catch up. No, there's an equal and opposite reaction to the downside, and we've felt that.
Yeah, and if you're listening right now and you're tempted to change the channel, I would say hang in there. This is a show about financial planning and a show about hope. So we're gonna give you some hope, but it can feel a little bit overwhelming as you're looking at this stuff and you're like, oh, this is the second worst start to the market ever in the year to date category. And this is where you would encourage folks, because you're right, earnings are off the charts, and what we've seen is inflation has come and eaten into those earnings. So net income now, with the most recent earnings cycle, is not off the charts.
But here's the thing, and this is the sort of concerning thing with all of this, is usually when markets throw temper tantrums, the Fed comes in with a spoonful of sugar, and really the opposite. It can happen right now. The Fed can't come in and do anything. In fact, they need to supply the actual medicine with no sugar, and that is creating even more concern. Right now, year to date, now we're recording this on Thursday morning, airing on Saturday. S&P 500 is down 17%. It was down 4% on Wednesday, one of its worst, I think the worst day since the crash in 2020.
Yeah.
Small caps, Russell 2000 is down 21%, NASDAQ down 27%. We have not hit that magical decline of 20% in large cap stocks, which makes it a bear market. We, at a low point a couple weeks ago, we got to 19.9%. I don't know in the couple days between recording this and airing if we'll hit that point. Right now, there's the length of this correction, which is a drop of 10% or more. The length of this correction starts suggesting like we could be seeing a recession. However, if we don't see a recession,
you mean a bear market?
No, recession.
Okay.
If we don't see a recession, these types of declines tend to come back very quickly in just a couple of months. But if this drawdown of nearly 20% is connected to a recession, then likely it might have some legs and could go a little bit further. But I mean, already being down nearly 20%, hopefully a lot of the pain is over, but no, we don't know. No one knows.
Yep.
And the smart guys that have predicted, 17 of the last 3 recessions
Yeah, right.
Are saying, well, a recession is a certainty within 6 to 12 months.
The folks that have been saying this for the past 15 months are saying, see, I told you. Well, listen, I know.
Every few years you get to have your moment in the spotlight, right?
Yeah. The broken clock is right twice a day.
The other thing that is alarming to investors right now is every investor has a decision to make as to how much offense and how much defense they want to play. Basketball might be a great analogy, but we're going to go with hockey because that's even better. And it's playoffs. So you've got a decision to make how many scorers you want out on the ice at the same time and how many defensive people you want on the ice. Now, traditionally, it's 3 offensive players, 2 defense, and a goalie. So you're 50-50. Half your people can score goals. The other half are designed to keep the puck out of your own net. But when you need to get a goal, you'll pull that goalie and you'll put another scorer out there. You'll pull a defenseman, you'll put another scorer out there. You've got that decision. How much offense and how much defense do you want to play? Right now, your defense isn't playing defense. And that is challenging as investors. Your bond investments that have actually, they're supposed to play defense. They've been playing offense for the past 40 years.
Right.
Are now no longer playing defense. We've got the worst year in the bond market ever. Now, they started the bond market, quote unquote, back when interest rates were already high, and they've been falling ever since. So it's really not a fair comparison. But down 10% is your safe, steady, predictable investments, and that's challenging for investors as well. So what adjustments should you make, if you should make any? What's the right perspective to have with all of this uncertainty in the markets? How do you make sure that you don't let your emotions get the best of you? We've got all that coming up on the Wise Money Show with Korhorn Financial Group. That went fast. Sorry, guys.
That's okay.
Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button and turn on notifications. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, but also on a couple local radio stations where we live, which is why the content is this size, this big. If you want something shorter, more concise, make sure you subscribe to this channel because we've got Next Wise Step videos, 10, 8 minutes, something like that air all throughout the work week, taking one financial concept, applying it directly to your financial life. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, leave questions as well. Thank you very much.
So, dude, you're talking about the defensive part of your portfolio being bonds, but dude, defensive stocks yesterday.
Yeah, got hammered.
Yeah, and I mean, to me, the cool thing to do is go and Google something like defensive stocks.
Yeah,
and see the articles from earlier this year saying, hey, you should you should load up on Costco. Costco was down 15% yesterday.
Yeah.
And so this is the other risk, I believe, if you're listening for, hey, just give me a name, give me a company to invest in. Mm-hmm. Oh my word, this is not a time to try and bet on the right pony.
Right.
Yeah.
Yep.
Right. Instead, it's the time to use tried and true strategies.
Yes.
And stick with those. Okay. So we'll start with, I think a point that I'd like to make is going back to evaluations were high. Well, where are evaluations now?
Okay.
And so what should the right response be? Panic, buying, selling. And I think if we use that to go into, well, wait a second, what are valuations? If valuations last fall were saying warning, what are valuations saying right now?
Right, but it still has to go back to the original point. Valuations, what valuations are right now, shouldn't matter.
Correct. Right.
So because your plan
Right.
should be
Have
superseding.
yeah, that's right.
Mm-hmm.
Yeah. And that sort of leads into the very next question. And then maybe we can get into 10 rules. Probably not in this segment, but I'd like to get into it. So I imagine if we're still talking about this is the second worst start to a year ever in October. Like at the rate we're going, this is going to extend well into the fall. This is the second worst start to a year.
No, dude, I'm not worried about October. I'm worried
Happy
about
Thanksgiving.
I'm worried about, Merry Christmas. This is the second worst start to the year ever.
At the beginning of the year, when you could, it was sort of interesting. Now it's like, okay, this is a stinky market.
How far does it have to go before it's the worst?
Yeah.
Have you checked that?
I don't. No, I mean that'd just be.
It would
probably
be
pretty
down
bad.
30 or it north of 30%, 40% down.
Yeah. All right,
that'd be a blessing.
Yikes.
The market has had quite a rough start to the year, and selling has intensified recently. How do you keep your emotions calm? And what's the wise thing to do with your investments? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out because a lot of other content is there as well. The markets have been moving quickly. We've had lots of content about the markets, reminders, perspective. So make sure you go to the YouTube channel, search the Wise Money Show, subscribe to it there, turn on notifications so you're made aware every time we drop new content. All right, guys, let's pick it back up. Last fall, we had very high price to sales. I think the highest ever. The highest market value to GDP ever. And so also signaling expensive. We've had the second highest valuations from PE, so from forward price to earnings ever. Okay. And we said, hey, there could be a storm coming. Be careful. Now, what are those valuations saying? What's the perspective with that? Should there be panic? Should you be selling? Should you be buying? Let's lump that all together.
Yeah. This is, we look at some pretty nerdy charts on a regular basis in our office, and sometimes we make our clients look at them with us. But
You're so mean.
I know, man. One of the charts that we look at is a measure of how expensive the stock market is, which is this metric that Mike keeps referring to as a PE ratio or a price to earnings ratio. And we said, yeah, in the fall it was really high. Not at the highest level ever, but it was well above average. Well, after all of this activity in the market and everything, we're getting back down to average, 25-year average. Now, the risk here is never does something go from being really high to just coming right back down to perfectly average and then just kind of go flat and camp out there. Averages come from being a little above where it should be and maybe a little below over time. You throw it all together, and that's how you arrive at these averages. But we're just now kind of getting back down to what average is. Mm-hmm. And, a lot of people are fearful, well, what if it goes even lower? What if we actually get down to levels that are true bargains again? And none of us want that. Mm-hmm. It's painful to go through. It's scary. In fact, I had somebody, I don't know if you guys experience this as financial advisors, but do people just kind of come up to you and talk to you about their investments? People that you barely know?
They do, and I always think I can't imagine what it'd be like to be a doctor.
Exactly,
because people are like, "Hey, can you look at this goiter on my neck?" And I'm like,
"I've got this rash. Can you just check this out?"
Actually, come to the bathroom with me. I'll show you.
Oh my! Well, so I had one of those experiences this past week, and it seems like a lot of people fall into a couple camps. One is they want to almost brag about how much money they've lost. Almost comparing battle scars or something. Mm. And then others who are genuinely fearful. And I encountered a genuinely fearful individual this past week, and she was saying, I'm down X percent. And I kind of commiserated a little bit. Yeah, a lot of people are feeling the ugliness of this year. She said, but my advisor told me I should be investing more. Can you believe that? Is that the craziest thing you've ever heard? And I'm like looking around like, well, no, it's not actually. It's maybe one of the smart things you could be prepared to do. You want to buy when things are low, right? Mm-hmm. But finally, I was kind of trying to encourage her and remind her of some of this historical perspective and everything. And she finally got down to the conclusion, maybe I just need to not be looking at my statements right now.
Oh, my, yes.
And it felt like a little bit of a win there.
Especially if she has an advisor. If she has an advisor, I mean, here's what I believe. I believe we are all hardwired to be horrible investors. So if I know that, even as a financial planner, I am hardwired to be a horrible investor, I need to be talking to my planner, not the voices in my head, not the voices on YouTube, not all of this other chatter that is a total distraction. And I need to stay the course. Mm-hmm. And the question is, do I have a course that I can stay? Mm-hmm. So if I have a course, I need to stay the course. I think the most fearful people right now, in my experience, are the folks that are retired, because their feeling of, hey, I can't really do anything about this is more acute than the folks that are working and might have a long, I've got 10 years to work or 15, 20 years to work. I'm not really worried about it. I'm just going to keep investing. I'm buying more. Yeah. This is good.
If you're retired, and we're going to tie this all to your financial plan, financial decisions, and investment strategy. If you're retired, you should have actual true defense. That defense that you were mad at for the past couple of years, and that is the amount of money sitting in cash, but your advisor telling you, nope, we need a couple years in cash. We need 18 months in cash just in case this gets hairy.
That's right.
Okay, couple of things to point to, Josh, what you said about the gal saying, well, I can't believe he would tell me that I should buy. Back on May 6th is when CNBC aired for the first time in a while the Markets in Turmoil special. And you all know what the logo looks like and everything. Markets in Turmoil. Guys, I'm looking at a chart here from Compound Investors and Analyst. This is one of the only indicators that has a perfect track record. And I'm seeing this going all the way back to 2010, and each day that that CNBC has run this Markets in Turmoil, and it's a perfect track record for 1 year forward return being positive. And I'm looking at this chart, and it's not like a little positive. It's 21% positive the year later,
Wow.
50% positive the year later, 39% positive the year later. So listen, when things are the ugliest, you're going through it. You're going to think through all the coulda, woulda, shouldas. Okay. Oh, I should have seen this coming. The timing, I should have known that this was the timing. But oftentimes this is the worst time to overreact. So therefore, what do? You stick to your tried and true long-term perspective of your investment philosophy, investment approach, okay? And you've got to make sure that that investment approach is connected with your overall financial plan. What are we talking about? Making sure that you've got a disciplined, diversified strategy, and ideally a diversified strategies. Because when markets are in crisis, all those different baskets that your eggs are in, they all kind of fall and break at the same time. And so having multiple strategies can help you provide or can bring additional diversification, because those strategies won't move in the same direction at the same time, or likely they won't. And so, but then you got to make sure that those strategies, that the risk that you're taking there is appropriate for your overall financial plan, that it's connected to your financial plan. Because even with that saying, if you're on the verge of retirement or in retirement, that doesn't mean you should have all of your money in those strategies. You should have some short term that you're pulling out of, so you don't need to sell something when it's down.
I would add to that remind yourself of your own time horizon as well.
Yes.
You know, that was the word of encouragement to this individual, because I knew that retirement, for example, is a long time off, and that's what she was upset about, her retirement plan at work. And you know, if this is money that you're not going to be touching anytime soon, then let it remain on the roller coaster ride that traditionally it's always made its way higher, right? And that these types of pullbacks, they have always been temporary. And that kind of historical perspective, I think, is something that we all have to remind ourselves of when we're going through these types of short-term fluctuations.
And beware of the phrase, "this time it's different," because I can give you about 6 different reasons why this time it's different. And those reasons, and smart people write lots of articles about this and get lots of airtime about it. I would not subscribe to that.
Yeah. So what are some reminders? What are some lessons? If this time isn't different, then what has the market taught us in the past that we should be reminded of today? Really, Kevin, perfect segue. We're going to be hitting those 10 reminders that investors need to know. That and more coming up on the Wise Money Show with Korhorn Financial Group. All right. So Bob Farrell wrote these.
Okay, so how do we find these?
I put it in the
Slack?
Wise Money.
Yeah. Bob Farrell, I think he wrote them in 1992.
Kevin, didn't we have the debate?
Oh,
It's different this time, or this time it's different?
this one?
I'm
Yeah.
surprised
That
Mike
one.
didn't say
Yeah, that one's
something.
in the outline.
It's different this time.
Yes.
That
Okay.
that is
I thought you were talking about something different.
that's the right way to say it.
You're saying it different this time? Bob Farrell, Merrill Lynch. Okay.
Different this time it is?
To refer to your... Okay, when did he write this? It was 92.
Which one?
These 10 rules have been kind of published and then republished and republished. I'm trying to figure out the original time. The first 4 you can kind of lump together. Or definitely the first 3. So I might say them together
Okay.
because it would take us, a full show to get through all 10.
Those are you could make a case those are the same
Essentially the same.
idea. I do like number 4 because if we go back and look at March 9th of 2009, or you go back and look at 2020, like the market popped a wheelie. And I remember watching it thinking the sentiment at that time was,
Yeah.
yeah, that's a dead cat bounce, right? It's
Right.
just-
Right.
Yep. All right. Oh, my goodness. There was something that one of you said right at the end of that segment that was the perfect lead-in, and I can't remember it now.
This time it's
Kevin.
different.
No. It's different. It's time. All right. With the markets being so tumultuous right now, what are they telling us? And not telling us right now, but what are the lessons that the market has taught us over decades and decades that we need to tune into right now to help guide us through this challenging time? We're going to remind you, we're going to help you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast, wherever you listen. Go check it out. Just search the Wise Money Show. When you're there, rate the program. We appreciate it. Subscribe to it as well so you can follow every show, every episode. Okay, so we're going through this challenging time in the market, and there's always this, sort of takes your breath away. You stop shooting your tracks, and you look at that statement or that performance, or maybe you look at what the market's doing, and you say, I don't know what to do, and you're sort of frozen. And oftentimes, our emotions can get the best of us, and we say, well, I just have to do something, and you take an extreme make extreme measures and move everything into cash and maybe not recover or whatever. The truth is, as Kevin said, I think right at the start of the show, this volatility in the markets, this is a feature of the markets. This isn't, while each pullback is sort of unusual in its way, these are tried and true lessons from the market. This is a feature of it. And so way back, I believe in the early 90s, I can't see the exact time, Merrill Lynch strategist Bob Farrell published his 10 rules for investors. And it's times like these that I find it's helpful to tune into those to kind of remind us that it's not different this time. And how should I get through this? And so let's get into these 10. And the first three I'm going to lump together because they're pretty similar, okay? The first one is that markets return to the average over time. Market returns tend to go back to the average over time. So if you have a season where the stock market has performed above average, then you should in the future expect the stock market to return below average, because that's how averages work, by the way. So that's the first. Second is essentially the same thing, and that is excesses lead to opposite excesses. So if you have outsized performance on the upside, you'll then likely have outsized performance on the downside that will get you back to the average, and vice versa. So these times of extreme pain that we're going through right now should be followed by some excesses to the upside. And then 3, excesses are never permanent. So the idea that, well, it's different this time, and therefore, PEs don't matter, price to earnings ratios don't matter. We've got a new plateau. No, that's not true either. Guys, perspective on these first 3 rules.
Well, I think there's been enough historical data to prove that this is true. And sometimes I think we take it as fact that, the markets return back to averages. Sometimes that gives us warning, and other times it should give us encouragement. Mm-hmm. When the market has had a period of time where it is just going like gangbusters and everyone's making money and it's way above average, we have to remember markets return to average. They will eventually come back down, and these good times, they don't last forever. But the opposite is true as well. When we are in some of our darkest days in the market and things are so ugly and you think, man, I just can't keep on investing like this, that's often a time when things will return to average. They'll get back to the long-term trajectory that the market has been on. And so be encouraged. It's not going to be ugly like this forever. In fact, that also should be kind of a warning to us. Don't miss the opportunity to be gathering up cheap investments during those dips when we're below average.
Yeah. So, okay, here's a data point from JP Morgan. 7 of the best 10 days in the stock market occurred within 2 weeks of the 10 worst days. So the best days in the stock market tend to be near the worst days in the market. And there's all sorts of studies that if you missed the best days in the market, your overall performance is is awful compared to the market.
right.
You can't keep up. So therefore, the fallacy that, well, I've got to avoid the pain, right, means you're going to avoid some of the very best days in the market, and the evidence of how you'll perform if you do that is just awful. I remember the bottom, the first positive day after the 2020 crash. It was skyrocket. It went straight up, and I remember talking to you, Kevin, saying, I don't think this is bottom, and it was, right? You just don't know. There's no way. So
Yeah, and I've seen a couple of those back in 2003, I believe 2002, 2003, in March of 2009, in 2020, and I can tell you the sentiment when things are bouncing, and they bounce off the bottom.
Yeah.
Like in 2009, the market was up 20 or 30% before anyone started to believe. But even up 20 or 30%, people are looking at saying this is not real. I just listened to someone saying buy or sell, and he said put my money in gold or get my money in cash, and so they're convinced. I mean, this is the problem. What people should be looking for right now and looking to is what are the time-tested truths? What are the systems and processes that allow me to accumulate wealth over time, and not say, hey, I need to figure out, is this market oversold? I listened to a guy on YouTube. He said the market's oversold, so now I should buy the dip. I'm like, no, don't buy the dip. Stay the course.
yes, that's exactly right.
But staying the course may be being a steady contributor to your investments,
yes.
and you will naturally catch the dips when you're doing that.
Oh, yes.
Absolutely. Yeah.
But a lot of people want to turn off their contributions when the market gets ugly.
Resist that one, especially if you've got your present financial position house in order.
Yep.
Do not try to either hit the gas or hit the brakes. Let it ride, because it's statistically you'll be wrong.
Yeah. I'm so glad that you pointed to your present financial position, because you're turning this investment discussion into a true financial planning discussion at that point. And your present financial position is the area of your financial life where you're doing budgeting, you have the right emergency funds in place, you're doing battle with debt if you have any of that, and you're just getting yourself into a strong financial position. And that is the basis for being a great, successful investor. You don't have to get emotional because the market is fluctuating or you're watching your investments go down, because you're not dependent upon that money. You've got enough cash to be able to get you through for a year or two if you're in retirement, or you've got enough cash and a great job with a great income to get you through even some of the shakeup in the short term with the economy.
So just speaking of excesses and things, in equal and opposite. So 2019, 2020, and 2021, the S&P 500 was up 90% in those 3 years. And you might say, well, it doubled because it came off a low point. No, it didn't. Nope, that includes the 2020 recession. If the stock market averages, where it's going to double maybe every 8 to 9 years, the fact that it doubles in 3 means we probably will expect something on the opposite end as well. Okay, market corrections don't go sideways. I already mentioned that one. So when the market finally realizes, wait a second, we got the cart ahead of the horse, it doesn't just stay still. It's going to have a rubber band kind of reaction there. But I need to mention this fifth one because it ties right into what we were just talking about. The public tends to buy the most stocks at or near the top, and the least stocks at or near the bottom. I understand. Go ahead.
I was just going to say, that's emotion at work, right?
Yeah.
We do the exact opposite of what makes sense because emotion is driving us.
Yes, it is. And that is why we're all hardwired to be horrible investors.
Yeah, and so therefore, if you're contributing to your 401k, to your Roth IRA, and you saw I put $1,000 in, and on my statement I lost $2,000, that was wasted money. Those $1,000 bought shares. They bought shares. Continue investing, and you're able to buy low. All right, the rest of the market rules, that and more, coming up on the Wise Money Show with Korhorn Financial Group. I have no idea. Good luck with that for WFRN.
Oh, for stop it. It'll be fine.
Okay. So they got 5 of the 10. That's why I wanted to sneak that one in there for sure.
It's all right. You pointed them to the article, so
Yeah.
gave them a teaser. They can go find the article.
So should we post in the Wise Money? Can we do this? The annual returns and intra-year declines. That thing from. I mean, should we reference that and post it? Because I look at this and I'm like, well, this is all I need to stay the course.
Yeah, exactly.
I mean, we can. I can't remember which video it was, but
I don't know if we can get away with it or not.
Yeah.
I mean,
Yeah.
okay.
Linking it?
Yeah. Linking. No. The
I mean, that's what I was thinking. Because I'm looking at the guide to the markets, the thing that the volatility slide deck. Mm-hmm. But it says despite average inter-year drops of 14%, and annual returns were positive in 32 of 42 years. Mm-hmm. So,
I would reference that, and then we can see if we can link it in the description. One of the videos we just did, and I don't know if it's aired yet or not, but it has that slide up where when I'm talking about it. So, all right, let's get back into it. 4-segment, landing the plane, 13 minutes.
Finishing the top 10?
Yeah,
Okay.
I think we should. What should your perspective be as an investor in these turbulent times? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, it's been just a wild start to the year, and again, we need to stop saying that. It's summer, by golly, right? So, but the market, depending on when you're listening to this, off 17 to 18%. NASDAQ down significantly worse than that, and a lot of that has intensified recently. There was a little bit of a bounce leading up to April where I think the S&P 500 had gotten back close to break even. It was only down 2%. And then I'm laughing because it's laugh or cry, but April, the month of April is the most positive month in the stock market throughout history. And I think it was 11 of the previous 12 Aprils had been positive. And April 2022 was awful.
Yep.
It
Not
was
this year.
It wasn't even close. It was terrible, and May has been the same, unfortunately. So what do you do? What sort of resolve do you have? What adjustments do you make? And instead of looking at, and by the way, if you missed it, we started with looking at the magnifying glass. What is happening right now? But now, it's hard to make decisions in the magnifying. That's sort of like making decisions in a vacuum.
Sure.
Instead, we want to pan out and look at what's the market taught us about these sorts of times from decades and decades and decades. And back in, I believe it was 1992, Bob Farrell, Merrill Lynch strategist, wrote and published his 10 rules for investors. Now, in 92, he was drawing on decades of research. So baked into this is nearly 80 years probably of what the market has taught. And we're going through those 5 rules right now. So number 6, the market is ruled by fear and greed, and that is stronger than long-term resolve.
Mm-hmm. Yeah, so
our short-term emotions are stronger than our long-term perspective.
Yeah.
By far, and it's tempting to trust what I'm feeling right now. That gets us back to, and I don't want to go back too far, but I mean, number 5, the public buys most at the top and least at the bottom. And Joshua's made the point a couple times, hey, keep investing. Well, I can't tell you how many times during turbulent markets like this, I've had clients say, hey, listen, I'd like to just kind of tap the brakes. Like, let's not keep doing the monthly systematic investments until the market comes back around. And that might feel better because there's this thing in our psychology that feels like, hey, maybe I've made a mistake. So if I don't keep investing, I will make less of a mistake. And your mind is playing tricks on you.
Yep, for sure. It's those emotions eating away at your ability to succeed long term. Your emotions will not be what drive you to succeed and achieve your goals. It is the long-term resolve. It's the long-term game plan. It's the rational approach that is easier to observe in hindsight than when we're going through it. And that's why I think it's important. you need to invest in your long-term resolve. Spend money to strengthen your long-term resolve. And to me, that's hire someone whose job is to remind you during the emotional times of the long-term game plan and to keep you on track, to help counterbalance those emotions that are just normal. It doesn't make you bad for having fear at times and feeling overly exuberant at other times. The point, though, is that when you act on those extremes, you're going to be thrown off your game plan. And so having a true game plan, having a certified financial planner who keeps you on the right course, that is a worthwhile investment. That will drive your long-term success.
Here's what it sounds like. I'm just playing this reel through my head. Here's what it sounds like. Okay, what's our strategy for investing? Yep, buy and hold, diversify, great high-quality, low-cost investments, maybe a momentum strategy, some other diversifier as well. Okay, that's the strategy. Things are getting really white hot. Well, should we increase risk? Nope, we're going to stick to that game plan. That game plan works. Okay, now things are awful. Do I make any changes? Nope, we're going to stick to that game plan. That's what it sounds like. These emotions, unless you're some stoic, and we've got a few of those in our office, you're going to have these emotions. But reminding yourself of the game plan and sticking to that game plan when things get overly emotional. So, okay, here was another warning sign, and this is point number 7 or rule number 7. Josh talked about valuations were high last fall, and when we saw inflation as well, and the Fed needing to do something in late, it was, watch out. One of the other things that we saw was that there wasn't great market breadth, and I can't even say that. You might not understand it. But what it means is the 7 point, markets are strongest when they're broad, and they're weakest when they're narrow. And last year, all momentum strategies struggled last year because you had just a few companies that started to do really well while everything else was not doing well. And then things dropped quickly, and then they reversed course quickly, and then they dropped quickly. But basically, the action was very narrow, and the index looked great, but it wasn't a broad advance. It was just a few companies within that index. We struggled with market breadth the entire year, and that's a sign, going back through history, of weak markets. Same thing happened in 2000, the tech bubble. It's happened many times before.
Absolutely.
So I thought this one was interesting. The 8th is that bear markets have 3 stages, and I will tell you that you can only identify these stages well past the event, okay? The first is a sudden drop, okay? And then there's the bear market rally, or the suckers rally or whatever, which people predict, 20 of the previous 3 of those or whatever. And then a sustained drawdown. And typically one that ends in some capitulation that, nope, stocks will never recover from this. This is awful. That's the experience.
Yep.
You just can't know which stage you're in until well after the fact. Because right now we don't even know if we're in a bear market. It's down 19.9%. That was its worst, at least by the time we're airing this, or by the time we're recording this. So just don't know. Any comments on those 3 stages?
No, I think it's just more of that emotional roller coaster ride. And I think the key is not just paying attention to how your emotions are affecting you, but also being aware that there are millions of other investors that are also reacting emotionally, and that can swing us to some extremes, but they're temporary. That is the key. Remind yourself regularly that this is a temporary decline, and this too shall pass.
That's right. All right, number 9, be mindful of experts and forecasts, because they're going to tell you, buy, or sell, and they're going to have their predictions, which I try to bait you guys into. You've noticed I've tried to bait you guys into forecasts the past few times going into a year, and I think Kevin nailed one pretty close. But I was more because we had seen some of the warning signs. I was more in tune with what forecasters were predicting for 2022. I even did a Next Wise Step video on this very topic where we actually looked at it. There was one of them that was actually negative or bearish. I think it was JP Morgan or Bank of America. I can't remember. One of them said they expected a 3% decline in 2022. What did the rest of them expect? The same thing, positive 12, positive 11, up 14%, up 8%, that the market would just continue doing what it always does. Guys, here's my truth serum with forecasters. Did anyone in December of 2019 predict a pandemic? No. No one did. Then how can you believe in any forecast?
But did anyone, when the pandemic hit and everyone was going home for our 2 years to slow the spread, did anyone predict that the Fed was going to print such a voluminous amount of money that the stock market was going to bounce and go up basically 100% over the next year and a half or two?
Yeah, right.
And did anyone predict that with all that cash in the economy, like 60% more money in circulation than has ever been before, that we would do another round basically in with the ARPA Act?
I would certainly not have predicted it, right?
Yeah.
So you don't know, and the thing that I wouldn't predict, which actually you did make a prediction earlier in the show, Mike. You said the Fed is not going to give us any sugar with our medicine here, and because they can't. And I'm like, I know. Don't be so strong, right? Yeah, I would not say that they can't, because a number of the things that they've done, you'd say, well, they can't do that. No, they can't, but they sure did. And so we'll look back and we might see, hey, these were some of the greatest monetary financial blunders we've ever seen, and we're all going to be suffering for it. And so I'd say, well, if a time of suffering is coming, make sure you're prepared. Like I don't want to be the one saying the sky is falling, but I would be the one saying, between the ant and the grasshopper, be the ant.
Yeah, that's good. I'm remembering back to 2009 and 2008 when the world felt like it was just completely falling apart. And, we were reading and watching, listening to everything we could get our hands on to try to understand that there was some historic events going on, and we were trying to learn about it and everything. And I remember being very intentional about trying to get both ends of a spectrum. Trying to listen or read regularly certain forecasters, certain people who are providing commentary and interpretation and everything on one end of the spectrum, but then get the other end of the spectrum as well, and trying to read the same people on an ongoing basis. Because I think it's really important that you know and understand what the biases are of the people that are feeding you thoughts, okay? Now, you know what your biases are, your own biases are, hopefully. You probably know what your closest friends are, but do you know what those forecasters are? Do you know whether or not this person is just always negative or this person is just always positive no matter what's going on? Well, you need to understand it. But here's a modern day twist on that. You also need to understand, what are the algorithms feeding into your news feed? What articles and what videos are being put in front of you? These computers are so stinking smart, they know what you're going to click on. And they're going to feed you the things that just strengthen your own thinking already. This idea of confirmation bias is real. We tend to try to gravitate towards the people that tell us what we want to hear.
Yep.
Right.
The 10th rule, if you're waiting on the edge of your seat, is the worst. It's obvious. Bull markets are more fun than bear markets. And to me, if you cut through that, it's no, the market, the stock market experience contains bulls and bears, contains highs and lows. You can't avoid them. Okay. And therefore, yeah, it's challenging. Bear markets are challenging. Work with your CFP. Make sure you've got a tried and true long-term investment strategy connected with your overall financial plan. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.